Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are going to start off with Audit and Assurance pre-mock exam for June 2025 session. Now, generally the rule that I say with every paper or the structure that I follow is I go with the predictable areas first because I know what's going to come there, so I don't want to put my head into the risky stuff first, then grab all the marks from there, then go to the unpredictable areas. Now, for the AA paper, we know there's section A and B. Section B is highly predictable with a lot of topics that's definitely going to come up. And then there is section A, which I don't know what's going to come up. Now, the problem over here is, or not exactly the problem, something that I do different over here is I start with section A, the unpredictable area, then go with section B. Now, the reason why I do that is section B is of 70 marks long and it's a lot of typing to do. So when you get into section B, that whole section B itself looks like a whole question paper for 100 marks. You'll keep on writing to a point where you'll actually forget that there was a section A, if in case you start with section B. So it's not mandatory you should feel like that, but there are chances that you might end up feeling like that because section B is quite long. So what I would do as a student is I'll start with section A itself because it's only for 30 marks. I'll finish that as fast as possible because there's not any numericals or anything that's going to come up. So I'll read the case study, I'll know what is the requirement and stuff. Whatever I feel is the right answer, I'll just quickly select it off. Finish section A as fast as possible, then go to section B. So that now my only concentration will only be on section B. I have no chance of forgetting that there is a section A on the other hand. So I can just keep on going like this. So this is the plan we are going to go with. Section A first, finish it off quickly, then go to section B. All right. Now with section B also we have some tricks that we're going to bring in. So we'll see about that. Now how our section A would look like, we have 3 case studies. Each case study will have 5 questions in it. Each question will be of 2 marks. So 2 into 5, that is 10 marks for one case study. 3 case studies are 30 marks. This is what we have over here. All right. So let's start with case study number 1. Before we read all the requirements, we'll just have a brief reading on the case study and understand what is there in the story. So your firm Bond and Company has 8 partners and has been invited by Mr. Smith, the managing director. You have 8 partner. Mr. Smith, the managing director and majority shareholder of Salvation PLC, to accept appointment as the statutory auditor for the company. So this is the client company, this is the firm. Then Salvation is a listed company, client is listed, and its principal activity is the manufacture and distribution of healthcare product. The present firm of auditors will not be reappointed for the next year's audit. So you are invited as to accept the audit over here, and the existing auditor is being replaced, which means you are a fresh auditor over here. This is a new client for you. Then your firm has several companies operating in the healthcare sector as clients, including Compassion. So you have other clients in the healthcare sector. They are also in the medical distribution of healthcare, manufacture and distribution of healthcare products. So it's a similar client. It's a new client for you, but then you have operated in the similar industry with the clients. Compassion is a large private company and has been a prominent client of your firm for several years, who is in the same industry. It is involved in the manufacture and distribution of healthcare products that are often very similar to the products offered by Salvation Company. So you have a very similar client with you that has been there for many years. The only difference is they are large private company and this one is a listed company. That's the only difference, but they are in the same industry and they do the same operation as well. Manufacture and distribution of healthcare product, manufacture and distribution of healthcare product. So as an auditor, it's a new client for you, but then you still know what all things are to be very careful about that client. So you're not going to have a lot of detection risk over here, the problems with a new client. Cool. In addition to statutory audit, Mr. Smith, who is Mr. Smith? Okay, the MD of that company, has requested that your firm assist with Salvation's corporate tax computation, fee for which will be significant. So it's a non-audit service and they're asking you to provide that, for which there is a significant fee that is going to come up. So automatically indicates that some sort of self-interest problem would be there for me because it's a high income for me. So I'll have this thing like I'll be very focused on helping that client company get to certain good figures, like some good outcome should come up. So I'll be forcefully doing it because I want to earn that income. So a slight indication of self-interest threat is there. We don't know, I'm just giving some random ideas from what we see from the money factor over here. Management at Salvation has asked, that is, client company has asked, if your firm would be interested in entering into a formal arrangement to promote their shares to potential investor. Promoting clients in front of someone else is called as advocacy threat. The firm will be paid commission based on the number of shares sold. So this is like a contingent payment. The more number of shares you're being able to sell to the investor, the more amount of commission I'll get. So from that point of view, I will try sugarcoating everything about the client company in front of the investor and earning maximum income. That is also a self-interest threat, and at the same time promoting is an advocacy threat as well. Then Mr. Smith has also suggested that a partner from your firm, other than the audit engagement partner of Salvation, join the board of Salvation company as a non-executive director, which means this is the audit team, this is the audit partner, but someone else other than this, some other partner in the company. This partner, they told over here, there are 8 partners in bond and company. So one guy is the partner for Salvation company. So some other partner out of the remaining 7, some other partner go and join Salvation company as the NED. Now what is the problem? This partner, if they go and join the NED of the client company, this partner who is going to audit Salvation company knows he is the NED. So they have a familiarity problem over here. Plus, he will somehow be knowing, not somehow be, he's the partner. So he knows all the audit team members also over here. So this audit team, when they go over there, they will not raise a lot of questions to this NED definitely, because they are part of the same company. So like this, lot of familiarity issues will also come up here. So now we understood the overall scenario, what all is happening with this particular case study. Now let's start reading the questions one by one. Identify by clicking on the relevant boxes in the table below whether each of the statements relating to the possible threats to bond and company's independence is true or false. So you have to say whether it is true or false relating to ethical threats for bond and company. Okay. The familiarity threat exists due to Mr. Smith's request for firm's assistance with Salvation's corporate tax computation. As this is a listed client, the threat is so significant that no safeguard is possible. What did we tell about the corporate tax problem? If your computation, if you're doing, the fee will be significant, which means because of the money factor, there is a self-interest threat over here. That is because of the money factor. Second thing, if you're doing this tax computation, let's say you did the tax computation, after that when you're doing the audit, you will do the audit for the tax calculations once again. That means you're doing your own work, I mean you're reviewing your own work. This is called self review threat as well. What did they mention over here? Familiarity threat. So because of this issue, familiarity threat is not there, so that is false. Next one, an advocacy threat is existing due to Salvation's management offer for formal arrangement to promote their share to a potential investor. The firm can only accept this if the commission from the arrangement is immaterial. First of all, that advocacy threat is there. That is correct. That we also mentioned earlier. Secondly, be it for small amount or be it for big amount, you should not accept it. So they told that the firm can accept it if commission is immaterial, but you should not do it. You should not promote your client shares in front of anyone, because that seems to be like a major thing. Even if it is immaterial, the work that you're doing is a material activity. So you should not be involved in it. So that is also false. Self-interest threat arises if a partner from your firm, other than the audit engagement partner of Salvation, joins the board of Salvation company as an NED. This can be accepted as Salvation's audit partner will not be involved. We told earlier over here, this is the point. First thing, it's not self-interest threat that will come up. There will be a familiarity threat between these people. That is first problem over here. So that statement goes wrong because of that. Second thing they're telling us, this can be accepted as the audit partner will not be involved. Though the audit partner is directly not involved, this audit partner is one among the 8 people in the audit firm. That means this partner will definitely be very close to the other audit partner as well. So when they go for the audit over there rises a huge familiarity threat between them. Because of this also, this should not be accepted. Plus, audit firm's member is not going and doing some major, oh no, sorry, is not doing some minor services in the client company. They are being part of the whole management level, like the board of directors. So he is becoming the NED. That is also not acceptable. So this also becomes false. So our first question is done. Let's move to next one. Which of the following factors would be relevant to your firm in their decision on whether or not to accept salvation's audit engagement. Which factors would be relevant to audit firm to whether or not to accept them? Okay. Audit team members might not have the required experience and skills required to audit this specialized sector. Though it is a specialized sector, you have a similar client who you have been auditing for a long number of years. So this is not a major sector, I mean major problem. You have the competence in your audit firm. So option 1 is out. Not big of a problem. Given the nature of business, auditors may not be aware of the financial reporting framework used to prepare Salvation's financial statement. Nature of business also, you're very aware, you're dealing with a similar client. So auditors will definitely be aware of financial reporting framework. So option B is also out. C. Bond and company will have to inquire from the client's management and the outgoing auditor the reasons behind not reappointing the previous auditor. That is correct. Because if they are not being reappointed due to client's problem itself, like let's say auditors found out some issues and there have been significant disputes between auditor and the client, and because of this client does not want to go forward with that auditor, in that case if you are choosing that client, you will have the same issues in future as well. So you do not want to deal with some unethical clients either. So you definitely want to know what is the reason behind not reappointing them. So this is one thing that is relevant for your decision. Number D, I mean option D. Audit fee offered for assignments may give rise to a self-interest threat that may exceed the threshold allowed by ACCA Code of Ethics. Safeguard will need to be implemented in the current year. Now, self-interest threat is there with regards to this non-audit service about corporation tax, but specifically with regards to the threshold allowed by ACCA Code of Ethics. This is the concept where ACCA Code of Ethics tells that your income that you're getting from this client should not be exceeding 15% of the total revenue in 2 consecutive years. Now, here, this concept of 2 consecutive years or that 15% revenue is highly unlikely to be met because they are inviting you to accept Salvation Company as the statutory auditor and they are not reappointing the previous auditor, which means last year you were not the auditor, this year you are coming as a fresh auditor. So, it is very highly unlikely that this concept of 2 years and 15% revenue and all is going to be met in the first year itself. Because of this, option D will not be a concern in this year. Maybe next year it can be a concern, but this year it's not a concern. So the auditor does not have to consider that point when deciding whether or not to go ahead with the audit engagement. So only option C will be the answer over here. Let's go to next one. Identify by clicking on the relevant boxes in the table below whether each statement is true or false. If Bond and Company accept the audit of Salvation Company, they will have to withdraw from the audit of Compassion. Compassion means that similar client, as there will be a conflict of interest. Just because there's a conflict of interest, you do not have to back off from the audit. You just have to maintain the safeguards and ensure that both of them are approving this. Okay, no problem. You can go ahead with the audit. So if both of them are approving, then no problem. You don't have to back off. But then you have to maintain the safeguard. So they are telling they will have to withdraw. So that is false. Bond and Company will communicate with the previous auditor to know the areas of concern, if any, which they must consider before accepting the audit engagement. The same statement is there previously. It also is like connected to why that reappointment is not happening. So this is true. Bond and Company should accept the audit engagement only if it has been established that preconditions for an audit are present. Now, this is a very theoretical point, not only with this particular audit engagement. Any audit engagement, if you have to accept preconditions of audit, that three things should be met. So, this is by default a theoretical answer, it's true. Then Mr. Smith was at a formal dinner with the partners of Bond and Company. Mr. Smith is the MD of client, okay, client and the partners of audit firm, where he informed the partners that while the additional services will be lucrative, that is that corporate, what is it? What tax service was it? Uh, Corporate tax computation being significant. So this is very lucrative. A clean bill of health in the audit would be crucial for bond company to obtain these additional assignment. Clean bill of health in the audit basically means the audit report should not say anything bad about the client company. It should say only the good things about client company. Even if some bad things are there, you should just close eyes to it and give an unqualified opinion. Okay, so unmodified report, unqualified opinion. So everything is positive. This kind of an audit report should be given in order to get that corporate tax services which is lucrative. So what is the client trying to do? Client is trying to create that interest in the audit firm so that they get more money, meaning they get their services done, and on the other hand, client gets a clean audit report. Now the question is, which of the following is a relevant ethical threat over here related to the statement to be considered before accepting the audit engagement? About the money factor, to get that, definitely auditor will feel that kind of no, kind of, they're being lured into this. Self-interest threat we already discussed over there. Let's see if anything else is meeting over here. Self-interest possibly could be the answer, but we can see if anything else is there. Management threat, the pressure is not there yet. They're just telling that like the situation is there. So management pressure or threat has not come up yet. Now this management threat may not be a word that you must have seen along the ethical threats. It's just meaning that intimidation threat part. So intimidation is not there yet. Self-review threat, self-review threat will be there later on once they accept that non-audit service. They do the tax computation, then they do the audit work. That time self-review threat is there. But at this point, before accepting the audit engagement or before accepting this work, self-review threat is not there. It is later on. So C is out. Professional competence and due care, professional competence is related to the technical knowledge that you have and things and all, and that has nothing to do over here about non-audit services, and nothing about the statement specifically mentioned over here either. So B, C, D is out. That means A is your answer. If consent by both parties were to be provided, okay, the statement is a conflict of interest arises when an audit firm provides a service in relation to two or more clients whose interest in respect of the matter are in conflict. In all cases of conflict of interest, a audit firm should make full disclosure to both parties and ask them both to confirm that they give permission in writing for the service to be provided. Since this statement is given over here, this already becomes a confirmation from that previous true or false statement that answer is a false over here. Like for example, if in case you were confused there whether it is false or true, for reading the statement you can easily understand that you have to make disclosures and you have to get some permission from both of them in order to proceed, which means that statement over there for true or false, which said that auditor should back off from that audit, by default becomes a false. They themselves are giving the answer over here. So if consent by both parties were to be provided, which of the following safeguards are recommended by code of ethics to minimize the ethical threat? So this also they're asking from the code of ethics point, which means it's a very theoretical answer. First one, having separate engagement teams who are provided with clear policies and procedures on maintaining the confidentiality. Correct. You should have this. Can't select. Okay, we have to select from here. Okay. So having separate engagement team who are provided with clear policies and procedures on maintaining confidentiality, one is correct. So it is either one, one, one. So automatically 2, 3, 4 is out. So either 1, 2, 3, 1, 2, 4, 1, 3, 4. What is common in all of this? 2, 2 is over here, 3, 3 is over here, 4, 4 is over here. Okay, so you can't figure out yet. Let's go to next one. Having an appropriate reviewer who is not involved in providing either service to the two clients to review the work performed. So like an engagement quality control review should be done. So 2 is also correct. So 1, 3 and 4 is out. So 1, 2, 3 or 1, 2 and 4. Now I have to confirm between 3 and 4 which one is correct. Establishing separation of confidential information physically and electronically. So confidential information, you're making a separation in this physically and electronically. So 1, 2 and 3 is correct. So by default 1, 2 and 4 will not be correct, but let's see what is this. A post issuance review to be conducted for both clients by an external accountant or regulatory body. Now this is post issuance review. Post issuance review means audit work is completed, audit report is published, then you are doing that review. They are asking what safeguards are to be taken while the audit is going on, how to maintain that ethical threat. Post issuance reviews after the audit. After the audit you don't need any safeguards, audit is finished. That means 4 does not become the answer over here. 1, 2, 3 is the answer. So that one is also done. Which of the following action should the firm take in Macbeth? What is Macbeth? This is question number 6, new case study. Okay, so let's read the case study. It is 1st July 20x5. Your firm is the external auditor of Macbeth Company for the year ended 30th April 20x5, and firm is the external auditor for 30th April 1st July. Okay, year end is over and the audit for the year is nearly complete. Okay, Macbeth Provide scientific services to a wide range of clients, which include testing food for legal additives and providing forensic analysis on items used to commit crimes to assist law enforcement. Oh, complicated stuff. Macbeth's income has fallen due to adverse effect of two high-profile court cases where Macbeth forensic analysis services were found to be in error. Not only did this provide bad publicity for them, a number of significant clients withdrew their contract. Some senior employees then left the company, stating that the lack of investment in new analysis machines was increasing the risk of incorrect information being provided. So things are going bad with the client. Management's assessment of Macbeth's ability to continue as a going concern covers the period to 31st Jan X6. What is the year ending? 30th April X5. They are covering it till 31st Jan X6. Okay, this is one direct indicator of something going wrong. Your time period for going concern assessment, which management has to do, should cover at least 12 months or something beyond that. Okay, so 30th April to 31st Jan X6 is not covering 1 year. So this is not right. Management's assessment is not covering the correct time period. A cash flow forecast prepared by the management for this period, cash flow forecast, okay, future, prepared by the management for this period, maybe this period means 30th April to this one maybe, shows that Macbeth required significant additional cash to maintain the current level of services. Okay. Consequently, Macbeth has decided to apply for a loan to ensure sufficient cash for operations in the next year. Okay. A firm has been asked to provide an assurance report on the cash flow forecast, which will be used in the loan application. Okay, so we have to not only audit the financial statement, we have to give a small assurance report on the cash flow forecast as well. Okay, fine. All right, so let's start reading the question. Which of the following actions should your firm take in relation to Macbeth's going concern assessment? Request the management extend the assessment period. Okay, assessment period, which we told about. So that 1 year thing. So request management extend the assessment period to 31st March X6. What is the year ending? Year ending is 30th April X5. So next year will be 1st May 20 X5 or 30th, no, 1st May 20 X6 or 30th April 20 X6. This is 31st March 20 X6. Now generally this is the time period or financial year we see, like 1st April to 31st March. So don't go jump into the conclusion that option 1 is the answer, because your uh, year ending is 30th April X5, not 30th March X5. Okay, so be careful. So 30th April to 30th April or 30th April to 1st May. So like this is how the cycle should be. Request that management extends the April assessment period to 30th April X6. So this seems fine. Perform additional audit procedures on the cash flow forecast to confirm Macbeth's going concern status. Additional audit procedures on the forecast to confirm going concern status, that is fine. But then, oh, anyways, we can't take two options. So only one is there. Okay, so this one will not be the right answer. Request management's assessment to be extended only if it raises doubts that Macbeth is a going concern. No, management assessment should be extended anyways to 30th April X6, regardless of engaging in more doubts or anything. Already concerns are there, that going concern issues are there, so you have to definitely do it. So yeah, since anyways only one option is possible, option B is the answer. Cool. So which two of the statements below regarding assurance provided by auditors on cash flow forecast is correct? Your firm Macbeth's auditor have been asked to provide assurance on the cash flow forecast. Okay. So they asked two options. Now this time you have to select two. Okay. Auditor would give reasonable assurance and a negative conclusion on whether cash flow forecast is accurate and assumptions used are reasonable. Now this first two things to understand. Reasonable assurance, there's like two wordings. Reasonable assurance is that you give for the financial statement, like whether, like a big analysis. Then you have a limited assurance. Limited assurance means you give small kind of analysis. So reasonable assurance is for financial statements. Limited assurance is for these non-audit or like the small services that are being given to you, small assignments. So here, reviewing the cash flow forecast, you're not doing it for major publishing service. You're just doing that assurance so that client can go submit it to the bank to get their loans approved. So this is like a limited assurance, not a reasonable assurance. So that is one thing. Second thing about this negative conclusion, the word negative does not indicate over here stating that cash flow forecast is wrong or cash flow forecast is bad. That does not mean negative conclusion. There's two things: positive conclusion and negative conclusion. Positive conclusion means that I have checked the financial statements, or I have checked this particular thing, and there is no problem in this. If I'm saying it is correct, it is correct. Trust me. If I'm saying it is wrong, it is wrong. Trust me. This is called positive conclusion. Negative conclusion means based on whatever checking I have done, I didn't find anything. Okay. Up to what I checked, I didn't find anything. But if you want, you can do more checking from your end. So don't trust me completely. Up to whatever I checked, it is fine. Or up to whatever I checked, it is not fine. But on further checking, you may find different information. So negative conclusion means don't trust me completely. Positive conclusion means trust me completely. This is the meaning behind it. Don't think that positive conclusion means saying it is good and negative conclusion means saying it is bad. So just get the meaning right. So we already told it's not a reasonable assurance to provide assurance on the cash flow forecast. So option 1 is out. Then this will be an agreed upon procedure as it is based on estimates made by the management before. Therefore, no assurance will be provided. It is an agreed upon procedure, meaning it's like a procedure that you're agreeing separately, and it is not exactly a complete audit of the financial statement. But no assurance will be provided is wrong. You have to give a limited assurance because it's already told over here that assurance is to be provided. So it's like a logical thing that you can provide an assurance, but not a reasonable one. You're going to give a limited assurance. So option B is out. Since they asked for two statements to be selected over here, which is correct. Since option 1 and 2 is out, by default option 3 and 4 will be the answer. Well, let's read through this. Limited assurance will be provided by auditors on cash flow forecast, and a negative conclusion would be included in the report. Limited assurance, we already explained what it is. Negative conclusion, this also we explained what it is. So C is the answer. D. Auditors would need to gather sufficient appropriate evidence to form basis of conclusion. Now, sufficient appropriate evidence is not only for limited assurance engagement, even for reasonable assurance engagement, definitely you have to find sufficient appropriate evidence. You should not simply give some random conclusions and all. So that is by default answer for any kind of assurance engagement. So option C and D becomes your answer. Next one. We're still in the same question, right? Eighth one. Which of the following audit procedures should the auditor perform in assessing whether or not Macbeth is a going concern? Which of the following audit procedure auditor is performing? Okay. So this is not about management, this is about auditor. Obtain Macbeth statement of cash flows, review the cash inflows and outflows, and assess the assumptions for reasonableness. Obtain Macbeth statement of cash flow. Statement of cash flow Macbeth would have made for the inflows and outflows for the year that have gone by. Okay. You have to check for going concern assessment based on future forecast, meaning what all is going to happen in future. Based on that, you have to see whether it's going to be a going concern or not based on what happened in the past. So option 1 is not the answer. Obtaining Macbeth's forecast statement of cash flows, then reviewing the cash inflow and outflow to assess the assumptions, then it is fine, it is okay. But this is about past. So option 1 is out. Since option 1 is out, option 1 will not be the answer. Option D will not be the answer. Now in this 2, what is it? 2 and 2 is common. 3 and 3 is common. So I just have to find out whether 4 is the correct answer or not. If 4 is correct answer, then option B is the answer. If 4 is not the answer, then option C is the answer. So option 4 is review management accounts for the quarter ended 30th April X5 to assess if in line with cash flow forecast or not. What was the year ending for our question? For the year ended 30th April X5. They are asking review the management accounts for the quarter ended 30th April X5. That means again you're looking at past information. 30th April X5 finished already. You have to look for future information to see if going concern is going to be met or not. I mean, going concern situations are there or not. So since this is also about past information, option 4 is out. So by default, option 2 and 3 becomes the right answer. Let's read through the right answers now. Evaluate management's plan for future actions, including their contingency plan in case of the loan application, if in case it is not approved, and consider the feasibility of these plans. Okay, so all about future analysis we are doing. So this is right. Review the company's post year end sales and order book to assess if the level of trade are likely to increase and if the revenue figures in the cash flow forecast are reasonable. So again, post year end sale means after the year end what all things are happening about future, how these things are going, and does it look like it is going to go in a positive increase figure, or is it going to go down, or is it going to be stable. You're again analyzing what's going to happen in future. So both 2 and 3 is about future analysis. So this is what auditor should do to check whether Macbeth is a going concern or not. So we're done with this question. Let's go to next one. Which of the following statement is incorrect regarding the auditor's responsibilities in relation to going concern? They're asking what is incorrect, which means most options are going to be correct. How much we can select? We can select only one. So there's going to be 3 correct options and 1 wrong options. Okay. Evaluate management's assessment of the company's ability to continue as a going concern. Yes, you have to assess the management's assessment. Why? Because that's why we told earlier to ask them to extend it until 30th April, because their assessment was not correct. So definitely you have to evaluate that. First one. So first one is correct option. We want to select incorrect option. Okay. Second one, remain alert throughout the audit for events or condition that may cast significant doubt on the company's ability to continue as a going concern. So that is also by default you have to maintain as an auditor. So that's also correct option. Option C, obtain sufficient appropriate evidence to determine whether a material uncertainty exists which may cast doubt on company's ability to continue as a going concern. Correct. Decide whether or not the company will prepare its financial statement using the going concern base of accounting. If going concern problems are there, we will tell the client company, let's say going concern issues are there, then we will tell the client company, see, you should not make it on the basis of going concern basis of accounting, you should make it on the breakup basis of accounting. We will tell, but who will decide on how to make it? Like, just because I said, client does not have to listen to it. If they want, they'll listen to it. If they don't want, they'll not listen to it. So who is going to decide whether the financial statement is to be on going concern basis or liquidation basis? Client will decide it, not me. I will only advise them, or I will only direct them, telling that what is the correct one. They should decide it. So it is not the auditor's responsibility to decide. Auditor's responsibility is to advise the company how to do it. Decision remains with the client company. So deciding whether or not the company will prepare this is based on client company. So this is incorrect over here. So these 3 are correct. This is incorrect. So option D is your answer. Question number 10. Okay, this is the last one over here. The auditors have concluded that there is some material uncertainty related to going concern. Management has included a disclosure regarding this material uncertainty in financial statement. Which of the following statements on audit opinion and audit report is correct? So these are 2 things always remember. Audit report is like the big picture. How do I show this? Okay, let's say this is the audit report. Audit opinion is like the final conclusion in this. So this is audit report, this is audit opinion. Okay, now they're asking what is the situation over here? Some going concern issues are there. Client has accepted that, and client has included disclosure also about this, which means if disclosures are made properly, that means my audit opinion is correct. I will give a positive opinion. What is a positive opinion called? As unqualified opinion. Okay, so I'll give an unqualified opinion telling that financial statement is all correct. When I say financial statement is all correct, it's not only about the accounting entries, it's also about the disclosure note. I'm telling that everything about financial statements and everything about the disclosure notes are all made properly. Hence, I am giving an unqualified opinion. Everything about financial statement is true and fair view. Next thing, audit report. This will be unmodified if in case it is in the raw format. I am not using any extra paragraph, or I'm not using anything additional. I'm just going with a normal audit report with an unqualified opinion. When will this become modified? This will become modified if in case I'm using some additional paragraph, or I am changing the opinion. Here what is happening? Opinion I'm not changing. Opinion I'm telling it's unqualified. So what will happen? If anything related to going concern issues are there, and if they have disclosed it already, this is disclosure note. Okay, let's say here disclosure note is there about material uncertainties, it's mentioned over here. So what I will do is I will add an additional paragraph over here, MURGC paragraph, material uncertainty related to going concern. So I'm telling to the user, see in paragraph number, let's say 1.5.6 in the disclosure note, there is things related to going concern mentioned over there. So go and read it from here, meaning the disclosure note. So what I'm doing is I'm adding an additional paragraph to direct it towards this disclosure note. So I'm giving the user an idea that, okay, something about going concern is mentioned over there. Don't miss it out. So I'm just giving a direction to that. So I'm using an MURGC paragraph, and because I'm using an additional paragraph, it becomes a modified report. So what will be the conclusion? A modified report where MURGC paragraph will be used, but I will issue an unqualified opinion because they have made the disclosures correctly. Hope understood the scenario and everything. Now let's read this statement. They're asking which of the following on the audit opinion and audit report is correct. If material uncertainty is adequately disclosed in financial statement, auditors will give an unmodified opinion. So unmodified opinion, correct, and will include an emphasis of matter paragraph in the audit report. Not emphasis of matter paragraph, MURGC paragraph. So paragraph went wrong. So option A is not correct. B. If material uncertainty is not adequately disclosed in financial statement, auditors will give a qualified opinion. So that is correct. If disclosures are not correct, means financial statement has gone wrong. If financial statement has gone wrong, this opinion will change. I will tell that financial statement is not completely correct. So it will become a qualified opinion. And it will include the MURGC paragraph in the audit report. That is wrong. What is MURGC paragraph telling the user? See in paragraph number 1 point something 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 in the disclosure note about going concern is there. So this is like a redirection to going concern disclosures. What is mentioned over here? Not adequately disclosed. If it's not disclosed over here, then how will I redirect over here? I can't redirect anything, which means I cannot mention the MURGC paragraph because there is nothing to redirect. So that MURGC thing is also wrong over there. Third one. If material uncertainty is not adequately disclosed, auditor will give an adverse opinion. Qualified opinion is like a minimal thing. Adverse opinion is like a major thing. So now that depends on the going concern situation, how significant or less that is. And it will include an emphasis of matter paragraph that we already explained earlier. It's wrong. Going concern issues are not mentioned under emphasis of matter paragraph. It's under MURGC paragraph. So since ABC is out, D is automatically the answer. If material uncertainty is adequately disclosed, auditor will give an unmodified opinion. So that is right. And will include an MURGC paragraph over here in the audit report referring to the disclosures in financial statement. So hope all that is sorted. And option D will be your answer. So we're done with the 10th one. That means second case study is over. Now we are on to the third case study and the final one for section A. It is 1st July 2005. Your firm is the external auditor of Fang Forest Furniture Company, Triple F. Okay, for the year ended 31st March X5, 31st March X5, 1st July X5. Okay, year end is over. Triple F has been trading over for 20 years and manufacture and sell table and chair. Current liabilities are shown on Triple F's SOFP as follows. These are 20x4, this is 20x5. Trade payables are there, 916 to 984. Payables increased. Accrual is there, 61 to 65. That also increased. This is about current liability. Okay, this is not accrued income. This is accrued expense itself. This is trade payable. So all about this is liability only. Then provision for legal action. Okay, something came up in the current year for 70,000. Provision for legal action relates to claim from a customer who suffered an injury while assembling a chair supplied by Triple F. Directors of who is doing this? Customer. Okay. Directors of Triple F dispute the claim, although they are recommending an out of court settlement to avoid damaging publicity against Triple F. So they're disputing the claim, meaning they're telling that no, nothing happened from our end, but they are recommending an out of court settlement. That means something is definitely going to be paid. So Triple F is guilty of this. So they definitely will have a payment going to happen because they themselves are recommending an out of court settlement. So probably something could be there. Let's see. We'll see based on the case study. Based on the question. Which two of the statements below are correct generalization regarding the factors which will influence the auditor's judgment concerning the sufficiency of audit evidence obtained? Two statements I have to find out about generalization, correct generalization regarding the factors which will influence auditor's judgment concerning the Sufficiency of audit obtained. Sufficiency means sufficient quantity. Okay, so generalizations about the quantity of evidence obtained. So you have to find two statements which is correct. Okay, less evidence will normally be collected on items that have been assessed as high risk. No, if it is high risk means I have to collect more evidence. So option A is out. Where accounting and control systems are poor, more evidence is necessary. Correct. When controls systems are poor means control risk is high. When control risk is high, more evidence is needed. So option B is correct. Where auditor has good past knowledge of the business and trusts the integrity of staff, less evidence will be required because they know the business really well. So chance of errors or other risk coming up is less. So less evidence is required. So that is fine. You should not blindly go with this. That's why they told generalization. Generalization means just like a first round of primary mindset. Okay. You always have to be skeptical about everything because you're the auditor. But you know about the general ideas about the client or general idea about quantity of evidence collection. That's what they're asking here. Where findings from related audit procedures are satisfactory, more substantive evidence will be collected. If findings from audit procedures are satisfactory, you don't have to collect lot of evidence, you have to collect less evidence. So option D is out. So option 2 and 3 will be the answer. In the audit of trade payables, audit of trade payables, okay, this one. Which of the following is correct reason for the procedure? Reason for the procedure, okay. Using automated audit tools and techniques, obtain a list of all debit balances and obtain an explanation from the client company. Okay, trade payables means it will have generally a credit balance because you will have to pay something. So if you have a debit balance means something in the accounting may have gone wrong, or maybe you, instead of crediting the payables, you by mistakenly debited it. That could be the reason. Or instead of debiting receivable, you debited the payables. That could be the reason. So something wrong with the accounting, because that is the only situation where you'll have a debit balance in payable side. Or maybe you had 100,000 payable, and instead of that you ended up paying 140,000, so you overpaid the supplier. So there also a debit balance will come. Maybe you're expecting some returns from the supplier, so that also could be a reason why debit balance is there. So when you're finding out the debit balances and you're obtaining an explanation from client, something about this wrong accounting or some why this debit balance came up, this is what you're going to find out while doing this technique. So whatever matches that is going to be the solution. Okay. Number one, if I am doing this, now let's read it like this. Okay. If I am doing this, it will assess the completeness of recording of the purchase invoices and ensure that post year end invoices are included in the payables if the goods were received before the year end or not. If I simply look at the debit balance and get a confirmation, I am not going to get any information about what is the post year invoices, or when did the goods receive in the company, and if it's included in the payable or not. Especially if it's included in the payable, it means credit balance should go up and not debit balance. So I'm not going to get any information regarding option A from this. So that is out. Second one, this will confirm why the balance arose. Okay, if I am doing this particular technique or procedure, this will confirm why the balance arose, which balance, debit balance arose, and help consider reclassifying the amount as receivable. That was one example I told. Instead of debit receivable, maybe I would have did debit payable. So that could be a reason for that. So it will help in reclassifying the amount as receivable. That is one valid point, but still we have two more points. Let's see if anything else is matching. Okay, only one will be the answer. So let's see what is the remaining ones. This will agree the payable balance to independent third party evidence to confirm the accuracy, completeness, and existence of balance. No. If I'm looking simply at the debit balance, then I'm going and asking the client company why this debit balance came up. There is no confirmation or nothing that I'm getting from the third party over here. So there is no agreement, or there's nothing that I'm agreeing to the third party evidence over here. I'm just looking at the company's record, asking to the management. So no third party, everything is first party only. So option C is out. Option D. This will confirm that the goods delivered to customer. Customer. This is liabilities, no? Trade payable. Goods delivered to customer. Customer comes up in receivable stories, right? Okay. This will confirm that goods delivered to customer close to the year end have been recorded in the correct accounting period. If you deliver something to the customer, it is either debit cash credit revenue or debit cash credit, or no, debit receivables credit revenue, because goods it is, that means your work is done, so revenue credit is there. It's either debit cash or debit receivable. There's nothing about payables over here, so option D anyways will not be the answer, so option B is the answer. So that was out. Next, identify by clicking on the relevant boxes in the table below whether each of the audit procedures are appropriate or not appropriate. Okay, review payments after the year end to determine whether any accruals are required. Okay, this will confirm classification of accruals listing. If in case I'm looking at, let's say if let's say this is the year, financial year, okay, and here let's say 100,000 accrual is there. Post year end over here, I'm looking at review the payments made after the year end. If I'm making, let's say, some 20,000 payment at this point, it means it should have been recorded over here at the year end. It was an accrued payable, that's why I'm clearing post year end. That means about this balance at year end, what am I getting? I am just getting an idea whether this figure over here was correct or not, whether this payment I made over here was it included at the year end payable or not. This is what I'm getting as a confirmation. I am not getting any idea based on this whether it is to be recorded as a accrued payable or a trade payable, or what is the classification. I'm not getting any idea about the classification. I'm getting an accuracy in the amounts, whether this payment was recorded over here or not. So I'm getting an idea about the completeness of this number. So it's nothing about the classification of the accruals listing, it is about the completeness of the accruals. So this is not appropriate. Next one, recalculate a sample of individual accruals. Recalculate a sample of individual accruals and match to supporting documentation to ensure accrual has been correctly calculated, therefore testing for under or over statement of each accrual. Okay, that is correct. When you're looking at individual accruals, meaning let's say Mr. A, I have to give this much, Mr. B, I have to give this much, Mr. C, I have to give this much. Or if it's something about salary, accrued salaries, or let's say about salary itself, accrued Mr. A this much salary, Mr. B this much salary, Mr. C this much salary. This is the accruals I have, individual accruals. What am I matching it to? I'm matching to supporting documents. What could be supporting documents? Let's say payroll records could be there about salary of people, or some attendance sheet could be there with the who marks attendance. Okay, someone will mark the attendance and all, so attendance of these people will be there. So based on the attendance and based on the payroll record, if I recalculate it, I'll understand for this particular month, maybe after deducting all the holidays and all, how much I have to pay for Mr. A. So this documents I can compare with the accruals listing that I have to pay Mr. A a particular amount. So what will I confirm from here? If I do this correct confirmation, I can find out that accruals has been correctly calculated, that I have to give Mr. A this much, and it will also help in understanding whether it is under or overstated. So this is correct. Option D, agree the accruals to payments made after the year end to ensure the accuracy of the balance and confirm that the accruals are genuine. That is, let's say in the accrual I've written Mr. A, I have to pay $20,000 at the year end. Then I'm looking at the post year end bank statements, like what I have paid, and I'm seeing that okay, to Mr. A I have paid 20,000. So what am I getting a confirmation over here? The accruals recorded for Mr. A at the year end is correct. So accruals, agree the accruals to payments made after the year end to ensure that the accuracy of the balance over here, and confirming that the accruals are genuine. So you made that payment, so this is also appropriate. Next one, which of the following procedures on the provision for legal action is incorrect? How many options we can select? Okay, only one option. So they're asking which is incorrect. That means 3 are correct, 1 is wrong. Discuss the provision with the directors to evaluate whether the company is liable for the payment and confirm that an out of court settlement is appropriate. Okay, that is something seems correct. Let's see if something else is wrong. Obtain a letter from Triple F's lawyer to provide evidence on whether Triple F may be liable for payment and check the amount provided is approximately correct. So you're just getting a third party confirmation from the lawyer. This is also correct. Review any correspondence with the customer to help determine triple F's liability and determine whether the customer may accept the out of court settlement. This is also a third party evidence you're getting from the correspondence, because it was told over here they are recommending an out of court settlement to avoid damaging publicity. So you want to know with the correspondence with customer whether customer is agreeing to this or not, that out of court settlement. So this is also correct. If possible, trace the payment made before the end of the year to receipt from the customer stating that payment is accepted in and full and final settlement, that is no other payments are expected to be made before the year end. If in case before the year end it is made, then there is no more legal actions, right? Because before the year end, if something is paid, and if the customer is telling that, like a receipt telling that we have accepted full and final settlement and no other payments are expected to be made, in that case there is no need for a provision for legal action. Plus there won't be any concept of this thing like out of court settlement and all. Plus you are at 1st July 20x5, year end is already over 31st March x5. So if at year end 31st March x5, if already the payments are cleared, that means this provision for legal action should not be there at all. So that concept does not go right at all. Okay, that statement itself goes completely dumb. You can trace for payment made after the year end. Like 70,000 is recorded at 31st March x5. If after the year end it was paid, let's say only 60,000, or if it was paid 100,000, that means you will have to make some modification for this amount. Okay, so like this, post year end, if some payment is made, then you can trace it back to this figure and see whether it was approximately correctly recorded or not and all. But in the year end, definitely no payment will be made. So that is out. So option D is the incorrect one. Option A, B, C is the correct one. Or you can, if in case you didn't understand the statement, you can think like this. Anyways, three options are correct. I mean, three options will be statements will be correct. They want one incorrect option. So A, B, C is correct. So D by default will become the false option. Moving to the last 15th question for our section A. Which of the following are substantive analytical procedures for wages and salary? What is analytical procedure? You're doing some comparisons. Comparison between what? Maybe this year and last year figure. Maybe this year forecast figures and actual figures. Maybe your figures and your competitors' figures. Your figures and industry average. So all comparison is called analytical procedure. Number one, they are asking for two, so I have to select two options. Trace and agree the total wages and salary expenses per payroll system to the draft financial statement. So you're not agreeing two different records, you're just confirming whether the wages and salary expense in payroll system and financial statement is correct or not. So you're just doing like a substantive procedure to confirm the amounts. So that is out. Recalculate the gross and net pay for sample of employees. Agree to the payroll records and investigate discrepancy. You're recalculating the expenses for employees, and you're looking at the original source documents and confirming whether the amounts are correct or not. Again, you're not doing any comparison between two different documents, you're just confirming the amounts. Option B is out. That means by default C and D will be the answer, but let's see what is it. Compare the current year total expense to prior year and investigate differences. So you're comparing two same records, last year expense and this year expense. Perform a proof and total calculation and compare the expected expense to actual expense with the draft FS. Proof and total calculation means, let's say last year there were 100 employees and everyone was paid $10,000 as the salary, for example. Proof and total calculation means we will, as an auditor, I will just do a calculation for the next year, assuming, okay, there were 100 employees, 15 employees will be leaving the company, retiring, and maybe 10 new hires will be made in the year. Everyone will have a 5% hike in their salary, and new 10 people joining will have, let's say, $5,000 as their basic salary. So we did a rough calculation of what could happen in the next year. Then we will estimate all this and just do the calculation. Now that should be the expected expense for the next year. Then what we will do is we will look at the actual expense. How much was the salary? Then we will see how much is the difference between these two to get some idea if it has increased beyond some normal levels, or if it has decreased beyond some normal levels. So this is called proof in total calculation and comparing that expected expense and the actual expense that happened. So again, you're doing a comparison between two similar records. So here also this is analytical procedure, and that is the answer for question number 15. And with this, we are done with our section A for AA pre-mock exam for June 2025 session. Hope this video was helpful, but this is not our major area for concern, because everyone for the AA paper is waiting for section B on how we solve it, because that is for 70 marks, and that is the major predictable area over here. And most of us will be preparing really hard to score all the marks of section B as well. Section A is not that it's not minor, or it's not that it's not important, it is equally important. But then yes, the key area, the most awaited section of this exam, which is section B, we will see in the next video onwards. But there we have much more tricks that we are going to apply in scoring all the easy marks. So stay tuned, see you in the next video.